In today's video, we're going to talk about how to protect your DAO against a flash loan attack. Hi, my name is David. I'm a Web3 consultant. You can find more about me on my website, on Twitter, or on LinkedIn. So before we even talk about the DAOs, let's talk about flash loans and how can it be used for arbitrage. So I'm going to give you a simple example using used cars as an analogy. So suppose that you go to a certain website where they sell and buy used cars, and you see someone posted an article saying that they're looking for a very particular car, and they put the specification of the car, and they're willing to pay $25,000 for that car. And you, being someone who knows a lot about used cars and know about different websites, you know that you've seen before a car with that description on another website, someone who was willing to sell that car for $22,000. So you very quickly realize, well, this is an excellent opportunity that I can just, buy the car from the website B at $22,000 and just turn around and sell it on website A for $25,000. And just like that, you can make a $3,000 profit just with a few clicks. So that in a nutshell is arbitrage. So find a way to buy the same asset for a lower price and then sell it somewhere else for a higher price. So this works, this example, but only if you have $22,000 in your bank, right? Or at least you have a credit card with that amount, with that limit. But what if you don't have that money? So one option that you can go to a bank and ask for a loan, but a bank usually doesn't give you money like that, right? They're gonna say, well, first of all, you're a client, and if you're a client, do you actually qualify for this loan? Do you have a good credit record? Do you have any collateral and any assets like a house that we can use as something that to, if you cannot pay the loan, that we can get back? So there's gonna be a lot of conditions. So maybe actually at the end of the day, you might not qualify for this loan, so you cannot take advantage of this arbitrage opportunity. But in the world of crypto, there's flash loans. So I'm gonna try to explain how a flash loan works using another analogy. So let's suppose that you go to a bank and you're the client, and then there's a teller, and you ask the teller, hey, lend me all your money. Like, give me all the money that you have in the bank right now. Lend it to me, right? So in a regular situation, that's not going to happen. But in the world of crypto, with flash loans, that actually is a possibility. Because in this case, the teller will tell you, sure, I'll give you all the money that I have in the vault, and you only have to pay $100 for this service. But, so you have some unique conditions. You're going to have to pay the loan back before the bank closes at 5 p.m. And you cannot leave until the bank closes, right? So they will know exactly where you are at all times. You cannot just leave with all the money from the bank. So you pay $100, you get all the money that the bank has. You can do whatever you want with that, but you cannot leave the bank. And you have to return the money before the bank closes that day. So maybe going back to the example, maybe the bank has $1 million that's able to lend you in this way, and you can perform a very similar activity as we saw before with the car, but let's say at a more higher range with a plane, for example. Let's say because the bank loaned you $1 million, you can now go to a website to buy a plane for $1 million, find a different website with someone that's looking for the same plane but willing to pay $1.2 million. You buy here, sell there, everything digital. And then, when you finish selling the plane again in website B, you return the money to the bank, and you made a profit of $200,000 just by paying $100 for the flash loan, right? So if we now try to put this in crypto terms, so there are lending protocols like Aave, for example, who are willing to offer that service. They're going to lend you a big amount of crypto for a small fee, but with the condition that you're going to have to pay back that crypto loan in the same transaction that you requested the loan. And of course, you're going to have to pay also the fee for the flash loan. So in this example, we have some blockchain, let's say like that is Ethereum. And in some block of the blockchain, along with some other transactions, you can perform one transaction that says, okay, first I'm going to borrow 1 million USDC, which is like a stable coin, from some lending platform, let's say Aave. Then I'm going to use that $1 million to buy as much ETH as I can from some decentralized exchange that is selling ETH at $3,000. And then I'm going to go to a different exchange or decentralized exchange that's actually their price of ETH is a little higher, so I can sell the ETH there for $3,100. And after I made the transaction, I'm just gonna return the amount of USDC that I borrowed and plus the lending fee. So you can see you can make a pretty good profit doing this, paying only the lending fee and of course the gas fee to execute the transaction. But the condition is that you have to execute the whole thing in a single transaction. It cannot be in 2 transactions, it cannot be in 2 blocks. So let's see how this can be a vector of attack for a DAO. So in a previous video that we discussed how Uniswap works, we discussed that in order to create a proposal, you need to have some minimum amount of tokens, which usually 0.25% of the whole supply of the governance token. So only people who have that requirement can actually create a proposal for people to vote on. So you can actually take advantage of a flash loan, right? To, let's say, in a certain transaction, you say, well, first I'm gonna perform a flash loan. I'm just gonna borrow all the governance tokens that certain protocol has. Now I'm gonna turn around, I'm gonna create a proposal on this protocol for people to vote, right? And this proposal could be something like trying to take advantage of the DAO. And the smart contract is gonna allow you because you were able to borrow a huge amount of governance tokens, so you fulfill the requirement of 0.25% of all the supply. And as soon as you create the proposal, you just go and return the governance tokens, right? So looking this in a timeline, you can see that in the previous block, so the hacker in this case is the person doing the flash loan to try to create a malicious proposal. So in the previous block, the hacker didn't have any governance token. In the block where the proposal is created, the hacker has millions of tokens borrowed from this lending protocol, at least at the time that the create proposal gets executed. And then in the next block, the hacker again has no tokens because the flash loan, you have to return the tokens back in the same transaction. So here we can see that the hacker is able to bypass this restriction at a very minimum cost. One way to prevent this problem, and which is actually implemented in different solutions, is that when you deploy your smart contract to allow the creation of proposal, instead of measuring the voting power or the voting weight for someone to be able to create the proposal, you don't do it in the same block that the proposal is created. You actually use it as a snapshot of the previous block and say, okay, whatever is the amount of votes or tokens that you have in the previous block, that's going to be your voting weight that is going to count towards this 0.25% of tokens that you need to create the proposal. So this, of course, now is gonna prevent a hacker from exploiting a flash loan to create a bogus proposal, because sure, you can perform the borrow the tokens first, create a proposal, and then return. But the proposal is going to be looking at the previous block and say, well, in this previous block, actually, you had 0 tokens, so you don't qualify for creating a proposal. So the transaction is going to get rejected. So this is a very common way to protect a smart contract that implements that is used by a DAO. And when we can see this protection in Open Zeppelin's governor smart contract, where you can see the flash loan protection in the function that you invoke when you want to create a proposal, look that is looking at, okay, so how many, what is the voting weight of the person trying to create this proposal? And look that it's looking at the previous block, right? So block number -1, and compare that, okay, what is the proposal threshold? So that's how Open Zeppelin's governor prevents a flash loan attack in this scenario. But let's look at different scenarios. What if, for example, as a hacker, you know, okay, well, instead of doing the flash loan on the same transaction that I created the proposal, what if I do it in the previous block? And this could be this wouldn't work just because when the proposal is checking for the snapshot of the voting weight of the previous block, it's going to actually look at the block when the block is settled, when all the transactions are fully executed. And because you have to return the governance tokens in the same transaction, when the block is settled, the hacker has 0 tokens. So it has no impact. It's still protected by the same mechanism. So no, this cannot be exploited, and the hacker only has enough tokens during the transaction, but after the transaction is completed, he's back to 0 tokens. So while this is running, sure, the hacker has millions of tokens, but when the transaction finishes and the block is settled, it's back to 0 tokens, it's balanced. But also, is this highly unlikely to happen as well, like trying to time a hacker to execute the flash loan in the block exactly previous to the proposal creation? This technically is possible if a miner is like looking at every transaction coming to the mempool, say, oh, so there's a transaction coming out to create a proposal. I'm gonna try to mine a block first where I perform a flash loan and then mine the second block with the proposal. But it's very difficult for a miner to guarantee to mine 2 blocks in a sequence. It's not impossible, but very difficult. But even if a miner is able to do that, it still wouldn't work. So we're good. So that protects about the process of creating a proposal. But then what about the process of voting on a proposal? So again, potentially a flash loan can be used to borrow governance tokens and then just vote for whatever option you want to win and then return the tokens, right? So in this case, we can see that the proposal was created in the previous block, and then in the next block, we try to perform the flash loan attack where we borrow the governance tokens, then we vote, assuming that we're going to have all the voting weight provided by the loan, and then return the governance tokens. Again, this is unlikely because only a miner will be able to perform this kind of attack, and it's hard to guarantee that a miner can mine 2 blocks in a row. But just in case, there's a protection that you can implement. And actually, again, Open Zeppelin, if you use their implementation of the ERC20 token for your governance tokens using the ERC20 votes extension, whenever you want to calculate, whenever you call cast votes, this function get passed votes gets invoked, and the block number that is passed is what is the block number where the voting is actually open for anyone to vote. And here the protection is that you cannot try to vote on the same block that voting is open, right? So it's trying to prevent accounting for your voting weight on the same vote and on the same block that the vote starts for the proposal. So again, this is to force you have to look at a previous block at least in order to calculate the voting weight. So trying to vote on the same block that a voting is configured to start will end up in a transaction rejection. So the flash loan is prevented, even though this was very unlikely to happen in the first place because of the ordering of the blocks. So in summary, we can see that flash loans allow you to borrow a huge amount of tokens by paying a small fee. What is actually could be more costly is paying the gas fees to execute the flash loan. DAOs can be attacked by hackers borrowing governance tokens to manipulate an election, right? So this protection you need to be aware of unless you're using something like Open Zeppelin smart contracts, because it has this built-in protection. But if you're building your own, you have to take these vectors of attack into account. Also, miners can be hackers and listen to the network to front-run an incoming transaction. It's unlikely, but it's not impossible. So you keep in mind that miners can also be hackers. So ways to prevent, we have seen a couple. First of all, calculate voting weight to create a proposal on the block previous to the proposal creation, right? So this prevents the flash loan, allowing you to have this 0.25% of all the volume supply. And also, when calculating a voting weight to cast a vote, don't do it on the current block being mined. So we saw that OpenZeppelin calculates on any previous block, but never on the same block because that block is not yet settled. That's it. That's how a flash loan can be used to attack a DAO, and how can you protect against that. I'll see you in the next video.